It's often said that it's not the first interest rate rise that hurts the most, but the last one. There's also been clearly a hullabaloo since the Reserve Bank raised interest rates yesterday. The greater worry, though, is the speed with which rates are likely to rise. Ratings agency S&P Global Ratings analyses mortgage arrears, in other words, those falling behind on their loans. And its Director of Structured Finance, Erin Kitson, who does a lot of that work, joins me now. Erin, many thanks for your time. Just tell me, even ahead of this interest rate rise that the banks are now passing on, what sort of shape was the housing sector, the mortgage sector in Australia in before that rate rise?
Look, Ross, thank you for having me. The mortgage sector was in pretty good shape actually before the RBA's rate rise yesterday. If you have a look at broader statistics, the proportion of highly leveraged loans, so that's loans with loan-to-value ratios, say above 80% or 90%, is not significant across the broader mortgage sector. Mortgage arrears are currently at very, very low levels thanks to a prolonged period of low interest rates. And also, if you look at the employment situation, that's obviously a very, very favourable outlook there, which is important for mortgage arrears and mortgage performance because historically mortgage defaults are very, very highly correlated with the unemployment rate. But in addition to all of those, we also have a pandemic nuance going into this rate rise period of a strong build-up in savings for many borrowers, which will help to provide a buffer to absorb the higher mortgage repayment costs, which are now in play.
Okay, so there's a couple of things here that people should understand, and one is called non-conforming arrears as compared with mortgage delinquencies. Now, a person can understand that a mortgage delinquency is when somebody gets behind in their repayments. Just explain that non-conforming arrears. What's the difference?
When we talk about non-conforming in our world, it's a different type of borrower, a borrower cohort. So non-conforming borrowers and the non-conforming subset of loans, which are a very, very small subset of the broader mortgage market, are borrowers that include, for example, borrowers with prior credit impairments. And in our non-conforming cohort, they also include a high proportion of self-employed borrowers, which are more vulnerable to changes in economic scenarios and interest rate rises. So I think the distinction, Ross, between, say, a non-conforming borrower or a non-conforming type of pool versus your typical prime bank-originated pool is, in addition to the types of borrower, that has different interest rate and arrears sensitivities. So typically what we've seen in prior economic cycles is that non-conforming borrowers will tend to feel interest rate rises faster, and you will see arrears on those particular cohorts of borrowers start to increase and come through at a faster rate than, say, your typical prime bank-originated borrower.
Okay, so then get me to some sense as to when the number of rate rises start to really feel an effect. Obviously, there's a build-up of savings. People have jobs, as you say. So people will pretty much do anything to keep on paying their mortgage to not go into arrears. But there's a point clearly at which some very highly leveraged borrowers do get themselves into trouble.
And I think it's not a straightforward question with an easy number to pin in the sand, because it really is very, very borrower specific. What you will see first, though, is that there is a reasonably high proportion of variable rate mortgages across the Australian market. So typically you will start to see arrears increases feed through first into those earlier arrears categories, and that will be reflecting that proportion of the more highly leveraged borrowers and more sensitive borrowers, which will feel that pinch first. So that type of transmission is fairly rapid given the reasonably high proportion of variable rate mortgages. Now, I think there are some other things that are worthwhile mentioning as well in terms of, the degree to which those early arrears increases translate to those more severe advanced arrear categories, so your 90 days, which are the more problematic ones, and what can stem that flow or what can help act as a mitigant to I think, address the speed at which those arrears arrears increases start to go through. And some of those mitigants there, a key one is the employment outlook. So the very low, historically low unemployment rate environment that we have at the moment means that acts as a bit of a buttress and a bulwark there against seeing significant increases in mortgage defaults. So that is certainly a strong positive at the moment. And I think in addition to that, there's also been a period of an increasing strengthening in lending standards in recent years, and importantly the inclusion of interest rate serviceability buffers, which are now at 3% by lenders. So that should also help ensure that the majority of borrowers should be able to absorb a moderate increase in interest rates. And whilst there may be some noise in those early arrears categories, which we expect as borrowers, reprioritise spending commitments, with the low unemployment rate environment and the strengthening in lending standards in recent years, what we are expecting though is not that those early arrears increases not to translate to significant increases in those more advanced arrears categories.
I'll tell you what, it's a really interesting and fascinating subject about what people will do to keep their mortgage paid. But the number one thing they always say is to keep your job. Erin Kitson from S&P Global Ratings, good to have you in the program today.